With Next Level Solutions. I'll say we got applause.
Wow.
Like that. Wow.
I know.
So,
It makes me nervous. These people might know me. That's kind of scary. So good morning, and can't get much better than Chick-fil-A and donuts, right? So let's go ahead and get started. And I will get started kind of on a personal level. I want to share a little bit with you about me. So I figure if we're going to spend an hour and a half together, you may as well know who's running their mouth up here, right? So I am married. I've been married to my wife for 24 years. The best thing that's ever happened to me. And we have two daughters that are both at LSU. One's graduating this year in business management, and the other one is a sophomore. So also have two female basset hounds and a female cat. And the majority of our staff at Next Level is female, so it makes me very comfortable that the majority of the people in this room today are females, because I'm surrounded by females my entire life. Been living in Ascension Parish since it was a bunch of cow pastures. I moved here 24 years ago. My wife and I live in the first home that we bought, and put two kids through private school and never got to upsize, so we don't have to downsize. But we've been proud residents of Ascension Parish for 24 years. We started this company called Next Level Solutions back in 2013. Originally, there were three partners. The original three of us, I'm the only one left. The other two, both great guys, great hearts, but we went our separate ways. And so we've now been doing this for about 6.5 years. I have been in this kind of, I've been in the business world for a long time, but as kind of an independent contract CFO consultant type role for about 10 years. And about 6.5 years ago, we decided if we want to do this, we better start building a brand and making a real company out of it. And we'll talk a little bit about that later. So I have a ministry background. I am a former youth pastor, and I play in a worship band. I play the guitar, and I'm a third string worship leader. So like when the two good ones get sick, they let me stand up there and do that. So it's one of my life's great passions. I'm also actively involved in prison ministry at Angola for about the last 6 years, specifically 10 guys on death row we've been working with for the last 2.5 years, or the last about 2 years, has been an incredible journey. And so the reason I mention that is because really who I am and what I'm about is really kind of what drives our company's mission. And our company's mission statement is to help companies and help people and leave them better than we found them. So when I'm here today, I really, really, truly have a passion for you leaving here having something that you didn't have when you came. And I think when you talk to people on our team, you'll find that common thread is there and kind of goes throughout our team. So, about the presentation. This is not the equivalent of an accounting degree. I do not have an accounting degree. I have a degree in business management. Okay, I'm not a CPA. So, but I will tell you that I will match wits with any accountant, any CPA, or any accounting professional on the mechanics of accounting and small businesses any day because I get it. And so I'm here to share that with you today. Hopefully some of the things that have clicked with me over the last several years being in business, I'm hoping to be able to explain some of that to you in a way that it clicks for you. So I want to encourage you. There's a lot of material here. I can't completely get away from talking about the theory and the debits and the credits, but the purpose of this is really for you to leave here understanding something. And so the second you want to raise your hand and ask a question, I want to encourage you to do that. If we don't make it through all of the material, those of you that are interested, I'll be happy to do a follow-up meeting somewhere or a webinar. Remember, our mission is to help companies and help people. So I truly do want to help you understand this material. You will find handouts. that I've kind of designed to make, to do two things: to engage you in the process, because as I'm talking, you get to fill in the blanks, and it's also to make it easier for note taking. So throughout the presentation, anytime you see a word in bold letters, believe in making things simple, that's one of the answers. So see bold letters, be looking to fill it in. If you're like me and that's even too hard for you, all the answers are in the last 2 pages of the handout, and it's highlighted by section. So feel free to ask questions and participate as we go through this process. All right, why is this stuff important? I can't tell you how many small business owners that I have debated with over why their accounting is important. So I thought I would highlight, and I could literally talk all day about why it's important. I'm one of those people. But I'm going to highlight a few of the reasons why this stuff is worth taking the time to do properly. How many of you have ever made a decision without all the information and it was a real good decision? Okay, yeah, you started to raise your hand because you've made a decision without all the information, and it's usually not a good decision. So having the numbers and having this stuff accurate is how you actually make informed decisions. I can't tell you how many times I watch business owners that look at their financials and they're not correct. They're making decisions with bad data because they just don't understand what they're looking at. So number one, it is what allows you to make informed decisions. Number two, and this is a bold statement, but it's true, proper accounting saves you tax dollars. If you don't understand the transactions you're making and the nature of those transactions, and you just do things because somebody told you and you haven't taken the time to understand it for yourself and to be the hero of your own story, it's going to cost you money. You're either going to end up paying tax on dollars that should have been deductible, or you're going to end up not paying tax on dollars you should have, and later in an audit, if you ever get audited, you're looking at penalties and interest to an organization that has unlimited power to take your stuff if you don't pay them. So that's somebody we don't want in our life, is the IRS, right? We want to keep them happy.
Chris, I'm going to ask the first question. So
Sure.
As complicated as our tax structure is, I mean, not just in Louisiana, but I mean, different sales tax collections that we had, state and locals have potentially a different sales tax. I mean, it almost seems impossible to keep track of all that, depending on what parish you're doing business in. I mean, because it could be different. Essentially, it could be different sales tax than, East Baton Rouge or Livingston. So,
Right.
I mean, it's just, it seems daunting, but I guess if you can just kind of have those basics put in place.
So the question is about, and I'm doing this for the camera, the question is about sales taxes and the complexity of all of the different tax structures and how can you possibly keep up with all that. And you're absolutely correct. I do this every day, and every client I go into with sales taxes, for example, what are for resale, where do we collect, what do we not collect on? It's ridiculous when you look at what you're expected to know and to administer. But what I'm talking about here is basically federal income tax. And so I'm not asking you to learn how the taxes are calculated, but what I am asking you to do is to learn how the dollars are accounted for so your tax professional can help you properly do your taxes. When it comes to sales taxes and property taxes, you need a professional. And if you think it's expensive hiring a professional, wait until you hire an amateur. It's really expensive. So does that answer your question?
Yes.
So proper accounting provides a foundation for strategic planning. If you don't know your numbers, if you don't know what's happened and they're not accurate, how do you predict what's going to happen, or how do you budget? It's almost impossible. You're just guessing. You're saying what you think is going to happen, whereas if you have data to work from, you can actually have a stronger foundation for strategic planning. Accurate data for government compliance. Once again, the government has unlimited power to take your stuff if you don't pay, if you don't do what you're supposed to do. And so, yes, it is complicated. It's very complicated. just imagine how much of a mess you can get in if you don't even try to do things the right way. So it kind of goes back to this saves tax dollars. The more effort you make to do these things, the easier it is for you to comply with different government agencies. It's easier to complete the returns and so forth. Finally, and this is the strongest statement of all of these. Working with a client right now who wants to sell their business. The first thing an investor does or a potential acquirer does when they want to buy your business is they say, let me see your financial statements and your tax returns. They want to know, and the reason they say that is that they want to be able to see how much cash the entity that you've created can generate without you being there. They want to know, and to the degree that your company can do that without you is the degree to which your value grows exponentially. So without accurate financial statements, you're then trying to explain, well, we expensed a lot of personal stuff in there. And if you're going to do that kind of stuff, then at least know how to track it so you can back it out and you can then prepare a set of financials that say, look, these are our financials, but this is the work we've done to separate for you all of the things that are discretionary. It's a great word for stuff you spend money on and get the tax break. That's not really a business expense, but the discretionary stuff. And that's really what they're looking to do is they want to justify that value through those financial statements. So, and this statement comes from working with several people that have been through this and gotten to that point and said, man, I wish I would have done a better job of doing this stuff. So it is important. It's not nonsense. It's not just something for those other people to do for you. It's something that as a business owner, you should at least understand the basics about. So let's talk a little bit about small business and the economy. Now, these are fascinating statistics. Over 99% of the 28.7 million firms in the United States, over 99% of them are small businesses. Now, that's a lot of small businesses. You would say, in fact, one of the videos on our website, I say that small businesses are 80% of the economy. And I said that because I truly believed it. But until I learned the facts that they're only 44% of the gross domestic product in the United States. So 99% of the companies produce only 44% of the GDP. The 1% produces 56%. Now, of these 99% small businesses, only 20% of those actually employ people. So that means we have a lot of one-person shows running around with an LLC, and there's nothing wrong with that. But you basically own your job at that point. You're not doing anything that's creating value for someone to potentially acquire one day or to pass on if the business revolves just around you. So this is a staggering statistic. And so what I would challenge you to think about is what happened if small businesses just stepped up their game a little bit? And I would also argue that this 1%, they don't do this stuff. They don't budget and they don't watch dashboards and they don't take the time to do things accurately and precisely. They don't do it that way because they're the 1%. That's how they became the 1%. So I would challenge you that if we all said, you know what, I'm going to start watching what I'm doing and I'm going to really start trying to improve, what kind of impact would that have on the economy of the United States, of Ascension Parish, and so forth? So now we're going to talk about some principles in accounting, because what I've learned, I remember when I took accounting in college, and I had the advantage. The reason this stuff stuck with me was because I was in my mid-20s, and I went to college late, and I had started my very first business, and I was taking accounting classes at night, and then I was going to work the next day in my business, and I was trying to set up my QuickBooks. I was trying to, buy assets and depreciate things, and it just clicked. When you just think about doing your homework for 24 hours straight every day for a year or two. That's pretty much what I did, and that's why this stuff sticks with me. But excuse me, there are 5. I think I have 5 of them here. There are some principles that I have found I've used continuously. So there's a lot of stuff that you're not going to get here, but these are ones that I have used a lot in my career, doing what I do, doing this stuff on a daily basis. So the first one is the going concern principle. Bold letters. In case y'all hadn't, I'm sure y'all already on that, right? Going concern. So what this says is that when we look at a set of financials, or when we prepare a set of financial statements and we're doing our books, our thought process is that we are doing this for a business that is going to operate in perpetuity. It's going to continue to stay in business. I've had clients sit down with me before and we're looking at the financials and they really didn't understand it, and they say, well, like, if I shut the doors down tomorrow, how much money would I have? And I'm like, that's not how it works. That's not what these reports are for. This is a going concern. That is the principle. So this isn't something that you use a lot, but you just need to realize that in these financial statements that you're looking at it as if this company is going to operate in perpetuity. The second critical component, this one is extremely critical in accurate financial statements, is the entity principle. The entity principle says that Chris King's household is a different entity than Next Level Solutions, or another LLC that I operate, King Technical Solutions. These are all separate companies. I have separate bank accounts. Now, it doesn't mean that I can't do transactions in between those companies, because anybody in this room that owns multiple companies will be able to tell you that's almost impossible to get away from, but there's a process to do that. You have to respect how the money flows between companies and how you spend money between different entities. That's when people mess up all the time. The third one is the historical cost principle. So the historical cost principle says that in accounting, when we put things on financial statements, we're putting them on the books, or we're accounting for them at what they originally cost. So a good example of this is, let's say that this is a business and that operates here, and this land was purchased for $10,000 20 years ago. And now it's worth a whole lot more than that. It's worth $150,000. It's on our books for $10,000. That's historical cost. So a lot of times that's something common that I run into. People look at financials and they say, well, yeah, but that's worth more than that now, and it doesn't matter. That's not how accounting works. It would work. That would go into the equation of evaluation if you went to sell your business. It would be a separate accounting for that. Yes?
Does that mean for like equipment also?
So the question is, does that count for equipment also? And yes, that's correct. If you buy a piece of equipment, let's say you get a deal on a piece of equipment, it's worth $100,000, you buy it for $70,000. It's going on your books for $70,000. That's just one of the basic principles.
But in the same way or capacity, wouldn't equipment have a tendency to depreciate as well?
Correct. So the question is, does equipment have a tendency to depreciate? And yes, it does. And we're actually going to talk about depreciation later. There are 2 types of depreciation, and we're going to talk about, there are multiple types, but I'm going to talk about 2 that are going to make some sense. So hold that question about depreciation. So the fourth principle is materiality. So I've been in lots of debates with people about how to do something, and we're trying to capture our cost a certain way, but it's going to take just tons of time to do something that really doesn't produce a material outcome. It doesn't produce an outcome that's going to have a material impact on the way the statements are viewed. So All of these things are correct, but if it's not material, it's okay to, it's kind of like, it's kind of like the trump card in a card game. Wait, I'm going to call materiality on that. We're not wasting our time to do all that because it's just not worth it. So that's something that you have to understand and you have to know how to apply. And then finally, what I think is probably the most important out of all of these, and they're all important, but this one's really important, is the matching principle. So the matching principle says that if we really want to know what we're looking at with our financials, we want our revenues that were generated in a specific period. We want to know that they were earned. We want to record them when they were earned, and we want to match the expenses that went along with that revenue. So in other words, if I make a sale for a $1,000 piece of equipment today, and the revenue goes in October, but the bill for the cost of that equipment doesn't come in till November 5th, and it's dated November 5th, the matching principle says, if you want to know how, what you really did, those got to be in the same period. And there are ways to do that through accruals or for, dating things a certain way or having your vendor redate the bill. I mean, there are a lot of ways to handle it, but the important thing to know is that the principle is that they have to match. If you want to look at accurate financial statements. So on that note, I want to talk a little bit about cash basis versus accrual basis. How many of you have ever heard those two words in business, cash or accrual? It's pretty common. So what cash basis says is that I don't care about the matching. When I write the check, that's when I'm taking the expense, and when I make the deposit, that's when I'm booking the revenue. It has nothing to do with whether you earned it or not. A lot of people will do their books on a cash basis for tax reasons. If you have a large receivable at the end of the year and you're billing it under the accrual method, you're booking that as revenue, which could increase your taxable income. But under the cash basis, you don't book those taxes until the money comes in. Now, I could argue, my businesses operate on the accrual basis, and I could argue all day long that I have actually more flexibility on an accrual basis than I do on a cash basis if you're trying to have things hit certain tax years. So just to cover the two, cash basis is when revenues and expenses are recording as the cash physically moves. So when checks are written and deposits are made. On an accrual basis, revenues are recognized when they're earned, not when I get paid. So if I do work for you today, when I give them the bill for $20,000 today for speaking for an hour and a half, they're not going to pay it right. No, I'm just kidding. Yeah, exactly. I'm just kidding, right? But if I were performing a service today and I invoiced, I would book the revenue now. They may not pay me for 60 days. They may never pay me, actually, if I invoiced them for that, but they wouldn't, as a matter of fact. So expenses are recognized when they're incurred, not when they're paid. So that is the difference between cash and accrual. I would argue with you, I look at any business owner and I drive them to accrual basis accounting. You can always convert accrual books to cash basis for tax purposes. The reason that I do that is because that gives you the truest picture of whether or not you're making money is accrual basis.
Chris,
Yes.
an example of a cash business versus an accrual. What does
Sure.
that look like?
So the question is, what is she was looking for an example of a cash business versus an accrual business. And the business type doesn't really matter. It's really the accounting method. So, and I happen to know her business because she's a client of ours. So if you were to, it's strictly an accounting practice. If you recognized your revenue when you deposited checks, you're recognizing that on a cash basis. If, say for example, when I send you a bill, okay, I send you a bill for the month of October. Let's say, now she pays her bills timely, but if you didn't pay your bills on time, I would book that revenue in October because I sent you a bill and I've earned that revenue. You may not pay me for 60 days. When the check comes in, it doesn't matter. It's not impacting my income statement. It's impacting my balance sheet. Am I making sense to you here? So it's entering things as they happened versus when the money actually moves. Does that make sense? Okay. So basic financial statements, and we're going to actually cover 2 of these today. We're not going to cover the third one. I'm going to talk briefly about it, but we're going to talk about the balance sheet. So the balance sheet, and this is from class, this is from college. The balance sheet is a snapshot in time, and those words ring in my ears because it's not, and the income statement covers a period of time, but that snapshot in time shows me what I owe, what I have, what I owe, and what's left over. But the important part about this slide is that it is a snapshot in time. It's as of a particular day. The income statement covers a period of time or activity. So, you know, I want to look at the month of March. I want to look at, you know, this week or however it is that you may want to look at it. It covers a period of time. Another word for the income statement, a synonym, is the P&L or the profit and loss statement. So if you hear somebody using income statement, P&L, profit and loss, it's all the same thing. The third one that very few small business owners actually use, and I've worked with hundreds of them, and I don't have one that actually uses this statement, the statement of cash flows. And so I'll talk briefly about the statement of cash flows because it's a very interesting report. But it takes your beginning cash. This is all it's based off of the balance sheet. It takes your beginning cash and it looks at all of the changes in your assets and liabilities over a period of time. And it looks at your ending cash, and it's fascinating. But if you take your beginning cash and your ending cash, in each one of those balance sheet statements either increases or decreases cash. So if AR goes down, cash goes up. If AR goes up, cash goes down. It's fascinating how it works. But if you do a cash flow statement, it will show you where your dollars went. Once again, not going to cover it today because it's really not a basic thing. Most small businesses don't use it. So the balance sheet, like I said, it's what you have, what you owe, and what's left over. Now, I'm not giving you the accounting equation, assets equal liabilities plus owner's equity, because that's going to just glaze you over unless this stuff isn't Greek to you. But in very simple terms, what you have, what you owe, and what's left over. Now, we can make this very complicated. We can talk about current assets and long-term assets and contra assets and liquid, receivables and inventory and all these different types of assets. But really what an asset is and what that section of the balance sheet is what you have. And then what you owe can also be very complicated, or it can be very simple. And what's left over. So if you owe more than you have, is that bad or good? It's bad, right? If you have more than you owe, that's good. So what's interesting though about this equity section of the balance sheet, and this is something that I never learned in school, that it finally clicked with me one day, is that the income statement or the P&L is really just an expansion of the equity section. So all of that income, all of that activity that happens on the income statement throughout the month through the year is either going to make you money or lose you money. And if you make money, what's left over gets to be bigger. And if you lose money, what's left over gets to be smaller. So it's really pretty intuitive. But that and when we talk about debits and credits in a little bit, and yes, that's coming. But I'm hoping to make it easy. When we talk about debits and credits, this makes a lot more sense of explaining. Like, I never could understand why you debited an asset to increase it, but you credited revenue to increase it. So it was kind of counterintuitive to me. It's like, well, wait, they're both positive things. Like, I'm selling something and I'm getting more of something. Why aren't they both debits? And the reason is that this what's left over section is a credit increases it just like it does what you owe. So in other words, this equals this. Assets equals liabilities plus owner's equity. There I went and did it. I went and said it. But the total of these two, and just think about it. It's common sense, right? What you have and what you owe and what's left over. What's left over and what you owe equals what you have. So anyway, we'll get into the debits and credits later. So if you have a question on that, hold it. Bring it up when we start talking about debits and credits. So here is an example of a balance sheet. And the idea here is just to put some names to what you have, what you owe, and what's left over. Cash, petty cash, investments, receivables, inventory, supplies, prepaid expenses. Okay, this is a really interesting concept. And this also goes to the matching principle. So I made it a point to include these concepts here as we talk about stuff. But with a prepaid expense, when I buy an insurance policy for the year, let's say I buy a $12,000 insurance policy. I don't want to, and I buy it in the month of January. I don't want to book $12,000 of insurance expense in January, right? I want to spread that out because I want to match. I want to match that expense with that year's worth of revenue because that was a part of what went with it. That's what's called a prepaid expense. So when I buy that policy, I book it to my balance sheet as a current asset, and I amortize it over 12 months. So and we'll talk about amortization in a little bit, but we're talking about it now, but it's actually on one of the upcoming slides. But the idea is to spread the cost of that insurance policy equally over the period of time that we're going to use it. So this is where y'all need to slow me down if you want to ask a question, because I'm more interested in you getting it than I am of getting through this material and then having half of y'all leave and not understanding something. Okay.
How is prepaid insurance an asset?
Okay. Because it is something that you have and you haven't used it yet. So if you cancel that, if you pay $12,000 for an insurance policy today and next month you cancel it, unless there's a minimum earned, which there usually is some sort of minimum earned, but you get a refund. So it's the same thing. It's something that you have purchased that you haven't used up yet. So it's an asset because it's something that you have. Who else had a question? Oh, the question on that one was, how do we know that prepaid insurance is an asset? Sorry.
Well, so to go back to that question, is if I'm paying it monthly, then it's not in the asset column?
This great question. You said if I'm paying it monthly. So it's very common. So the question was, if I'm paying it monthly, is it not in the asset column? If you're paying it monthly, this is very, very common, and it's something that businesses do wrong all day long. Very common to finance insurance, right? $12,000 policy, I pay $2,000 down, and I pay the rest of it out over 10 months, right? And what do most businesses do when they write the check for that insurance note? They code it to insurance expense. And what happens 2 months out of the year are not matched properly because the reason is we didn't separate what we have from what we owe. So if you finance insurance, when you buy insurance, if you finance it, the amortization of the policy is the expense that hits equally. The financed amount is a liability. And there's a principal and an interest component, just like there would be on a car note or on a truck note. So does that answer your question? I mean,
It does, and it could lead to a bunch of other questions, but I'll let you.
wonderful. I love questions. And like I said, if we don't get through everything, that's great. But if we do, great. So, and I actually give an accounting aptitude test to people when they come to work for us. That's number 16 on the test. It's very basic, because really everything you need to know about accounting in a small business, they taught in Intro to Financial Accounting in small business, or 90% of it anyway. So that question, though, is number 16 on our accounting test. So I'm glad you asked it, because I was about to talk about it next. So prepaid expenses are something that you have. So that liability side of the insurance would be a note payable, right? It's really just a loan. Now, some insurance companies, I have a client, and these are all different. They're not all the same. I have a client that has State Farm, and they pay no interest, and they pay 12 equal monthly payments all year. We're not going to go through all this. We're just going to code that to insurance expense, because it's matched properly, right? Going back to our principles, and that's just the way we would do it. All right. So what we have, what we owe, what's left over. Want to talk about what's left over down here. Now, this balance sheet, and something that you see in all of the accounting textbooks, is you see this equity account called common stock or treasury stock. Truth be told, the majority of small businesses don't have that. If you're a sub S corporation or a C corp, you would have stock, because you actually sell stock. But if it's an LLC, and it's owned by a sole proprietor, you're going to have owner contributions and owner draws, or you may have an owner equity and owner draws. That's typically what you see in a small business, not what's here on this stock example that I pulled off of the interwebs. Now, one other thing I want to touch on while I'm here is Goodwill. This is something that's interesting on the balance sheet. Some of you may have bought your businesses from other people. Goodwill is it is on the books as an asset, and Goodwill is the amount above and beyond the market value of the receivables and the equipment and all the things that you can put a dollar value on that you paid for the company. So if you looked at Next Level Solutions, and I'm just going to dream for a minute, and we were worth $5 million on paper, which we're not anywhere near that, but if we were worth a bunch of money, if you looked at our assets and the money we had in the bank and the receivables and all of that, but you were buying it for $10 million, then the purchaser of that, when they set up their new set of books, they would have $5 million of goodwill on their books. Does that make sense? Questions? Okay. So on the income statement, this is the one everybody likes to look at, right? Small business owners, I love to look at the income statement. Did I make any money? But what they really don't realize is that if the balance sheet's not accurate, the income statement's not accurate. So that's when people make decisions based off of this a lot of times. The income statement covers a period of time. It shows you what you billed your customers. It shows you what you spent on direct costs, or cost of goods sold is a synonym for direct costs. We're going to talk about that in a second. And what you spent on overhead or fixed expenses. Those are synonyms for each other. You will notice on some income statements or P&Ls, there's a section at the end of operating expenses that says other income or other expenses. Those would be income and expenses that are outside of the normal operations of the business. So give you an example, in our building, we lease part of our building to a client of ours. So when I show rent income on my P&L, it's other income. It's not part of my normal revenues, because I don't want to look. I want to look at how the company's doing. I don't want to count things that really aren't a part of what we do through our normal operations. Any questions on that?
So when you talked discretionary spending earlier, would that fall into this this category as well?
Good question. So the question is, does discretionary spending fall into this category? It depends on the nature of the discretionary spending. Usually what I see is that people will expense travel. Like their business, it's normal to have for the business to have travel expense, and then somebody might, expense travel. Well, in that case, it would not be normal. But if they, and normally the way to track that is through, not so much through the chart of accounts, okay? So when we look at an income statement, we have the chart of accounts on the left-hand side, right? Office supplies, revenue, and all of that. The typical way we would track those type of expenses is to create classes or tags or departments or some other kind of way to where we could use the same general ledger accounts, but then we have columns that break out these other types of expenses. Does that make sense? So here's an example. As part of your question, so like if we, in this case, we might have up here normal operations, and then we may have another column called owner discretionary, right? That we could use these same accounts, but have different departments or categories that they would call. They would all. You could run a report like this that they would all roll up, which is usually what they do a tax return based off of. Or you could, if you want to look at it from a management perspective, that's when you would break it out. Or if you were trying to show a potential acquirer, hey, this is what our company normally operates like. So on the income statement, everybody knows what revenue is because that's the first thing every small business owner learns is selling stuff and collecting money. That's the fun number. How much can we sell? So cost of goods sold is, or direct costs, are expenses that are generated when you sell something. They're specifically tied to a sale. And it's important to separate these if you really want to if you want to use this data to create pricing tools and to give you information to make better decisions with, you want to be able to separate out the expenses that are related to sales versus expenses that are there no matter what. So Alyssa, for example, your business, she has a stationery business. It's Paperwhite Boutique over by Burgersmith on Highland. They sell stationery. The expense of the paper and the stuff that they buy when they sell it, that's cost of goods sold. Now, you want to match properly, so we don't want to put all stuff that we bought in cost of goods sold because sometimes we have to hold inventory, which is an asset, right? Something we have. Sometimes we have to hold inventory, and it only hits cost of goods when we use it. And this is an area of struggle for just about any small business that has any kind of inventory, is tracking inventory. And then when do we apply the materiality principle to how much time is it really worth to track it? If you got $5,000 worth of inventory and it's $1 million a year business, are we going to use the materiality card and say, it's just not material, I'm just going to expense it all? But so anyway, couple of different concepts there. But cost of goods is when it's actually, remember, it's when it's actually used because it's matched properly. Yes?
Is cost of goods sold a landed cost, or do you break that out into freight expense?
Good question. Is cost of goods sold the landed cost, or do you break it out? So, and really, I'm going to change your question a little bit and say, is the inventory cost landed, because that eventually becomes cost of goods, okay? And yes, the cost of acquiring, preparing, shipping, getting that item into inventory to be ready to sell it is part of that cost of that item. Okay? So then when you sell it, yes, it becomes part of cost of goods sold. Does that make sense?
So would you rather expense that freight expense so you decrease your inventory valuation?
Well, what I would do is I would want to include well, first of all, is it material? So let's say it's material. Let's say it came on a container from China and freight was $20,000. That's material in most small businesses. I would want to match that cost as I used up that inventory. So that cost of that freight is a part of the cost of that inventory until you use it, and then it gets expensed. And the reason I would do that is because I would follow the matching principle.
I'm thinking like ad valorem tax, if you're trying to reduce that number for tax, that would be a separate issue?
So we have to make a decision. So the question is for ad valorem tax, which if you don't know what ad valorem tax, it's inventory tax. So when you buy stuff and you pay sales tax, that's not good enough. When you pay income tax on your profits, that's not good enough. All of the furniture and equipment and supplies that you own in your business, you pay tax on every year. And so you have to make a decision. Am I more interested in building the value in my company and being able to demonstrate that through accurate financials? Or am I more interested in taking the biggest deduction that I can so I pay fewer taxes? So that's kind of the trade-off. So yes, to answer your question, you bring it into the cost of inventory is higher, you're paying property taxes on that. So that's just a decision you have to make. I've made the decision that I feel like I'm stepping over dollars to pick up pennies when I do that, because when I have a real true picture of what I'm doing and I know to a science where everything is, that I'm going to gain more from that than I am not paying my 4 mills or property tax or whatever it is, you know. But that's a real good question. That's the struggle that every small business owner has. They don't want to pay taxes.
And I don't want to get bogged down on this subject, but I think it's pretty important. So I'm just trying to understand a little bit more. So just use an example. If it costs, just say $20 to ship the stationery to her business, I'm going to push that cost to the product into the consumer. So isn't the value of that stationery, isn't that freight cost then included in that inventory?
So the question is the freight cost included in the inventory whenever something is shipped in? And the answer is yes. That's not me standing up. That is part of generally accepted accounting, GAAP accounting, generally accepted accounting principles.
I think that's what y'all were talking about.
No, it is, and that was the answer that I gave Chris. But what Chris's point was when I do that, I'm inflating my inventory cost, which makes me have to pay this other tax, makes me pay more of this other tax. So that was his point, and it's a valid point, and it's the trade-off. So, and then, you know, my opinion is that it's more important to have accurate numbers for the reasons I explained at the beginning than it is to try to, you know, if you want to save money on taxes, use this discretionary thing I'm talking about, but I didn't tell you to do it, even though it's filmed and going to be on the interwebs. So, because it is not, that's not the way you're supposed to do it. All right. So this is a really cool analogy. I have a background in transportation, so I think of things like trucks and things like that. So when we're talking about this financial picture and managing a business, I kind of like to think about it like a ride in a truck or a car. And there are 3 components here. One of them is the rear view mirror, which tells me what just happened. That's when I get to a point where I can produce accurate and timely financials every month. I'm able to tell you what just happened pretty regularly. Most small business owners cannot tell you that. That is the reality of it. Most of them can't. They think they can, but they're not accurate. The next thing is what's happening now, which is the dashboard. So once we have established our foundation and we know what's happened in the past, we can then begin to build tools off of that data and the collection of that data that helps us look at key indicators. So like in our business, we're a professional services firm. So everybody's time is our inventory. So I'm looking at, on a weekly basis, I'm looking at how much of our time was unbillable. You know, I know that that is a metric that's going to drive profitability. Where are my sales month to date? That's a very simple metric that just about anybody can give you. There are lots of different examples in the trucking business. What's my miles per gallon? What's my physical damage cost? In the restaurant business, my food waste, right? These are things that if you manage them to a number, your actions throughout the period are going to impact your profitability positively. And then finally, what's going to happen? The windshield. So a lot of people say, oh, I got to have a budget. I need to plan. I need to do some future planning. In my opinion, when you do this, and I'm an expert on my opinion, by the way, so it is my opinion only. But my opinion is that if you go out and you focus on this before you know this stuff, it's kind of like building a house and deciding to put the carpet in before you put up the sheetrock and blow texture and paint. You know, you can do it. You're just kind of doing it in the wrong order. It's better to do it the other way. So any questions? This is where it's about to get ticky-tacky. This is where nobody's asleep yet. This is fantastic. Are y'all okay? Nobody's left. Nobody fell asleep. I see a couple of you dozing, but all right. So in accounting, did I just see somebody leave? No, okay, sorry. In accounting, every transaction is at least dual entry. So that means there is a debit and a credit. So for everything you do, there is a corresponding action to that. That's why in accounting we can't just make stuff up. Well, just put some more sales in there. Well, I can credit the revenue, but what do you want me to debit? You know, my choices are I can debit expenses or I can debit an asset, and then I've got something there that doesn't exist. If I credit expenses, I'm really stupid because I've made zero impact on my income statement. If I debit assets, I'm saying I own something that I don't own, right? Because I've added a debit there. So every transaction is at least dual entry, and the reason for that is it's to keep us honest. I mean, that's really why it's there. It's to make it to where you just can't hide. It's just very hard to hide stuff in accounting. Whoever came up with this stuff is a genius, because I still don't know who invented all of this. But so who in this room actually works with debits and credits, or has any? You do? Okay, so you have rental, but you have a set of books. You're doing transactions. You see journal entries, and is there anybody else in here who interacts with that kind of stuff? You do. Okay, so we all do. Who knows debits and credits? Like, you know this stuff already. Okay, good. That's good. Then y'all are going to like this part. Okay, so she knows how to balance a checkbook. So the first thing that we want to talk about is I'm going to give you some cheaters, okay? If you remember this stuff that you don't even have to write it down because you can just look at the answers. But if you remember what I'm about to show you, journal entries will make sense to you from now until the end of time. You have to remember just a few things. And what I find is that when you apply these principles, that's the trick, is you got to remember them and you got to make the leap from knowing them to being able to apply them. When you apply these principles and you remember what I'm about to show you, a journal entry is as simple as if it's complex, fill in the pieces that you know by applying the principles and these little cheaters I'm about to give you. And then it's usually pretty easy to figure out what you're missing. And that's how I passed accounting in college. I actually made really good grades in accounting, but that's why, like, I got it because I was like, okay, this is just a puzzle. If it's, and some of the more complex journal entries are, we had a car, we traded it in, and we bought another car, and we bought a warranty, and we financed it with 2 different financing companies. That's pretty complex journal entry. You do this stuff, and it'll make it easier. So here's what you need to remember. Whoops. Debits increase assets, cost of goods sold, and expenses. So if you remember that debits increase these, what do credits do to them? They decrease them, right? So I'm not asking you to remember it all. I just want you to remember half of it. Debits increase assets, cost of goods, and expenses. Liabilities, or credits, increase liabilities, equity, and revenue. Now, if you notice, if you remember what I was talking about earlier about being confused about how a debit increased an asset and it confused me why a revenue was a credit, credits increase liabilities and equity and revenue because they're all on that side of the balance sheet, right? It does seem like it's backwards. It seems like it's backwards, but it's not, because if you remember liabilities, remember the balance sheet, assets equals liabilities and plus equity. What I have equals what I owe and what's left. What I owe and what's left are together. So if I increase what I have left and I increase what I owe, they're the same thing, right? They're on the same side of the equation. One's good and one's bad, but so credits increase liabilities, equity, and revenue. And the reason for that is that P&L is an expansion of the equity section of the balance sheet. It's what's left over. It's how I create what's left over. Now, Carrie, you are not an accounting person. How am I doing? Are you getting any of this?
My mother was an accountant, so I've heard many of these things over the years.
So what you're telling me is I'm still,
Not getting it.
you're still not getting it. Well, why aren't you asking questions?
I need a
Well, I'm
picture.
not an accountant.
Yeah.
I need an illustration.
Who's not? Well, let's work on this then. Let's work on this.
I mean, I'm fine with everything but revenue. Credits increase revenue.
Okay, good. We're getting somewhere. We're getting somewhere. So I'm going to go backwards in the presentation. So bear with me a second, because this is important. Okay. Remember our balance sheet. You wanted a picture. I'm giving you a picture. We have, what we owe, and what's left over. Okay? This is the bad stuff on this side of the equation, and this is the good stuff. The more of this that we have helps offset the bad that we have. But they're on the same side of the equation because the assets are that's the big part, right? Hopefully, that's the big part. Liabilities hopefully are less than our assets, and then we have money left over. So because these are on that side of the balance sheet, that's why there's bad and good together. So that's thing number one. Thing number two, you see this retained earnings line? All that retained earnings means it is the cumulative effect of all of your income statement items. Okay? So on the income statement, so if I were to increase this equity, what do? I credit it, right? If I'm on my income statement and I want to increase my bottom line, what do I add? More revenue. What do I do to increase my revenue? I credit it. That's why you credit revenue. Does that make sense? Okay. Anybody else who didn't get it? I'm going to go over it again. Nope. If you got it, free drinks after this. Okay, so let me get through all of these now. So when I said earlier that income statement is just an expansion of the equity section, I was talking like a college professor, and that made no sense until we actually looked at it. That's what I meant when I said that, is that retained earnings line, that's part of your equity section. All that is the result of all your P&Ls. It's just showing you how all that works. So If you remember, debits increase assets, cost of goods, and expenses, and credits increase liabilities, equity, and revenue. You have half, you've got half of what it is to do a journal entry. So when you're making journal entries, if you use the principles and you use this, and I wish I should have done an example problem. The insurance one is a great one. But, okay, so anyway, I'm going to move on. If you have a question, stop me. Now, here's one we were talking about before. Carrie said, I still don't understand why the bank is different. When I go to the bank and who's ever had that? You have a debit card. But when you swipe your debit card, what does it do? It takes money out of your bank account, right? So, but I just told you that debits increase assets and your bank account is an asset. So isn't that confusing?
Yes.
Who knows why? Somebody in here knows why, so I don't have to tell you. Do you know why? No? Who knows why?
Flips with the bank is reducing their debt.
That's right. My bank account to the bank is not an asset. So accounting is done from the perspective of the entity, right? Done from the perspective of the entity doing the transaction, that when I go to the bank and I debit that account, I've just reduced one of their liabilities, not increased one of their assets. So if credits increase liabilities and I go to the bank and my bank account is a liability for them and I use my debit card, what did I do? I decreased their liability to me, so I debited my account there.
Then if I use my credit card, then I increase my liability to the credit.
If you use your credit card, you increase your liability because that's exactly right. That's why it's called a credit card. Now, what's interesting is a credit card company, they should technically call that a debit card because you're increasing their asset.
Yeah.
Right?
Right, yeah.
Right, but they're tricky. There's a reason they spend billions of dollars studying your behavior. So that's interesting, isn't it? When it starts clicking like that. Okay, what's your name again?
Walker.
No, not you, this gentleman.
Monty.
What's that?
Monty.
Monty, you asked a question earlier about fixed assets. We're getting ready to talk about that. Barker asked a lot of questions too, but not about fixed assets.
You gotta use the laser.
That's right. So fixed assets. So first of all, what is a fixed asset? It's something that I have, right? So it's an asset. And it is typically something that we're going to spread over a long period of time. So if you own rental properties, your properties that you acquire, you've got building and land, and those are fixed assets for you. If you buy insurance for the year, that's not a fixed asset, that's a current asset, but we're not getting that deep into all this. It's an asset. Depreciation is spreading the cost of an asset over time. So the example of, and when we do this, we're doing it for two reasons. We're either doing it for tax purposes or we're doing it for managing our business, okay? And we're going to talk about tax versus book in a second. But when we're doing it for our business, we are matching the use of that vehicle, the expense of the use of that vehicle over the period of time that we're going to actually use it. So if we buy a $50,000 truck and we're going to use it for 7 years, and we think it's going to be worth $5,000 at the end of 7 years, we're going to set a residual value of $5,000, but we're going to evenly spread $45,000 over 7 years. So at the end of 7 years, that truck is on our books for the residual value for $5,000. Now, so that's and I keep wanting to jump to tax, but I'm going to hold off on that. So that is that is called straight line depreciation. That's what I would encourage you to do for the purposes of managing your business and properly matching revenue with expenses. Amortization is the exact same concept, but it's for an intangible asset, such as prepaid insurance, like we talked about. We bought the insurance policy. That's not a fixed asset. It's really intangible, right? It's a bucket of dollars. It's something that we bought, so it's called amortization. It's really the same thing. It's the same concept. We want to spread that over a period of time. An example of a common intangible asset in business, small businesses, is leasehold improvements. So you get into a lease and you do a bunch of work to it, and you're paying your lease payment, but part of that might have been included in your lease. Part of it might have come out of your pocket. Well, you can expense all that if you want. And once again, this goes back to the cash basis versus accrual. You can do your taxes on a cash basis if you want. You can expense it all, or what you should do though, properly, if you want to really know how your business is performing, is you want to book that as a prepaid, as a fixed asset, and you want to amortize it. So if you spent $20,000 in leasehold improvements, I don't want to show that I lost that 20 grand in year one. I want to look at my books and know that those leasehold improvements are going to go over, if my lease is 5 years, then I'm going to spread it over 5 years. Now, if I release the building after that, I'm not doing anything with it. It's fully amortized, but at the time that I make the decision to amortize it, my lease is only 5 years. That's the information I have. That's the amount of time I would spread it over. Any questions on that? So, large purchases. So this is kind of what we're talking about with these leasehold improvements, is that is a large purchase. If you want to really know how your business is operating, when you go spend $10,000 on furniture or on a vehicle, you don't want to expense that right away. It's the same concept. You want to capitalize it. So large purchases get capitalized, which basically means it becomes a fixed asset, and it's something that you depreciate. And you will apply the materiality principle and create a materiality threshold of, for my business, what is a material thing to expense. And when I say expense, it means it hits your P&L. It shows that that's a hit on your production and your performance. Or do I capitalize it, meaning I still show the profit and I trickle the expense over time. You make a decision on that. Now, in our business, when we started it, there were 3 partners, and we had a valuation formula that we track every month based off of our performance. So if I truly buy something in my business, if I buy an $800 computer, I don't want to devalue my company, because if something happens and we exercise that valuation formula, I capitalize that. I will take an $850 computer at Next Level Solutions and I will depreciate it over 3 years, because I don't want to devalue my company. So I'm forced to make that decision when I choose to expense or capitalize, because it has a real impact on the value of my company to my business partner. So I don't know if that makes sense. That maybe helps tie back into that when we did the why slide, as financial statements are how you build value. Maybe that helps tie some of that together. So now here's another example about this. I said we were going to talk about tax versus book depreciation. So we've all listened to politics on the news, and this tax bill got passed, and George Bush had the bonus depreciation. Do y'all remember all this from bonus depreciation? Everybody loves bonus depreciation. Why? It's designed to stimulate the economy, because it gives you a way to reduce your taxable income as a business owner, so you can take that money and invest it back in the company that year. So there's absolutely nothing wrong with taking advantage of those, and we want to take advantage of all the bonus depreciation and all of the Section 179. That's another section in the IRS code that says that certain size businesses can write off 100% of an asset in a given year. We want you to take advantage of all that. But what I see happen all the time is your accountant is giving you journal entries to make at the end of the year to match your depreciation to their depreciation, okay? They are, and they're not doing anything wrong, but they're also not doing you any favors from a managerial perspective, because if I buy an $80,000 piece of machinery this year and write it all off, I don't want to look at my financials and think I lost $80,000 more than I really did. I want to say, back like with the truck, I want to capitalize that. I want to make it a fixed asset, and I want to say, how long am I really going to use that for? 20 years? Because I want to spread it over the 20 years, because that's truly how I'm going to tell if I'm really making money or not with my investment in my business. Now, it doesn't do me any favors from a cash flow perspective, because if I wrote a check and I paid cash for that, then I'm looking at my P&L that says I made all this money, but the money's not in the bank, okay? And that's really back to this going concern. We have to understand what the financial statements are there for, and that they're just tools. You know, if you ran a statement of cash flows, it would show you that that's where $80,000 of your cash went, because that asset, that fixed asset increased, which decreased cash. So you just have to understand how these things work. So I'm not telling you to go out and buy it and borrow money on it. You might, you know, some of you might do that. I'm an anti-debt freak. I don't like debt. I like to pay cash for stuff, but I have to realize that when I do pay cash for it, that it reduces my cash position now. It puts me in a better position in the future, right? But it hurts my position now. So any questions on fixed assets? We have about 10 minutes left. This time is going good here. It's perfect start time. I really had no idea how long this was going to take because of so this is good. We're going to finish up right on time. Okay. So how many of you are sitting there thinking to yourself, I got work to do. I got work to do with my books. Well, let's just assume that I've inspired you, that you're going to do something different, okay? Maybe I did or maybe I didn't. But let's assume that I did. How many of you have work to do at home with your books? I see some heads nodding. Is anybody going to raise their hand? Okay, Chris, good, yeah. So the reason I asked that question is because I want to give you the process to go through if you have made that decision that, okay, I really want to do this. I need some kind of order. Like, what do I do first? Because this is a lot of information. So, and this is exactly the process that we follow when we work with a client. When we go into a new client, this is exactly the process that we follow. And this picture, this black square, it may as well be a picture of a rearview mirror, because that's exactly what it is. These are the steps to knowing what just happened on a regular basis. These are not the steps to developing dashboards or budgeting or strategic planning. These are the steps to the basics. So the first thing is, and there's a copy of this in your handout, the first step is government compliance. And when I say government compliance, it means a lot of things. It means a lot of things for different businesses. I was meeting with a security company yesterday. They have certain requirements with licensing of security guards. It could mean sales tax compliance. It could mean I'm a small business owner and all of my income is passed through to my personal tax return, and I want to make sure I have enough money at the end of the year to pay my tax return and not owe the IRS a bunch of money. It could mean I haven't paid my payroll taxes in 90 days and I'm using that money to survive, which is a really scary place to be in, by the way. So government compliance, that's really the first thing you got to focus on, is getting getting to where you're stabilizing your situation, because when you're out of compliance with what the government requires of you, you're putting yourself you and your employees at extreme risk, because things can happen you have no control over. The second thing is that entity principle, or the entity concept, separating personal and business, and we've talked about that already, so I'm not going to go through that again. But really keeping an eye on that. The third thing that we do in our accounting system, whatever that may be, is we want to go in and make sure that all of our spending accounts are reconciled. So when I say spending accounts, I'm talking about checking accounts, credit cards, vendor payables, lines of credit, things that we use, that we get statements on. Now, the reason we do this, and we do this first, is because that is what tells us, when we follow these first 3 steps and we know that only business is running through here, when we reconcile these, every bit of the data is in our accounting system. So we know we've at least captured it. It's probably in the wrong place, and it's not coded right, and things are wrong, and things aren't following the right principles, but they're at least in the system. The next thing that we do after that is we run that balance sheet, that snapshot in time. Remember I said that if the balance sheet's not accurate, the income statement's not accurate? So we go through that balance sheet, and it's just as simple as looking at every single thing on there. Is that bank account right? Is that bank balance right? Or is that really my true accounts receivable? Do I have any old stuff on my aging that needs to be cleaned up? Are my payables correct? Are my credit card balances right if I have credit cards? Are my vendor accounts accurate? All of this stuff on the balance sheet. So what that does is, as of a given point in time, if we know that's accurate, then every bit of the drama and the trouble is on your income statement at that point. So you go through, you start determining what are my true direct expenses, my cost of goods sold, my fixed expenses, and you begin to tweak the way these are organized, and then that puts you in a position to do regular month-end closing. So in closing, I want you to realize that in business, I had to learn this the hard way, that different people have different opinions. And so to say that, oh, I have a bookkeeper and a CPA that guide me, that is an incomplete picture. That everybody has different pictures. I love CPAs. We have 2 of them on our team, people, but most of them have never run a business. Most of them, not all of them. There are a lot of CPAs in business, but other than their practice. You know, the typical track is you get your CPA certification, you go to work for a firm, you know, you work under another CPA, you do taxes, you begin this life from the perspective of the firm, which is you got to have that perspective. It's very important, but you can't only have that. And for some of the reasons we've discussed with the tax depreciation, like if you got to manage your business, so you need other perspectives. They give great advice, but it's not always practical business advice. You can't always just ask your business attorney, no offense, but they're going to come at you from a legal perspective. You know, I mean, you're an attorney, right? Or you passed the bar. Well, I'm assuming you passed. Okay. But would you agree with that statement that you have a limited, you've got a wonderful perspective, and you know lots of stuff that I don't know, that I have to call on you for your expertise. But
for example, as a CPA, I mean, most of them go into a firm and just start.
Yeah.
They kind of have their lane, and they stay in that, and you have to understand that they're staying in that lane too.
That's right. They stay in their lane. They are exposed to what they are exposed to. The knowledge I've gained over the things that I've been exposed to. I call the CPAs on our team. I'll sit down and I'll say, hey, what do you from an ethical perspective, what's your opinion on this? Or how do you, I value that, because they have, you know, they've got the CPUs, they got or the continuing education credits. I don't even, CPUs, what am I saying? That's a computer part, isn't it? CEU, continuing education units. So they have to keep up with all of that. So they're going to be more up to date on certain things, but it's just a different perspective. This is one of the most important positions in your life, and that is a trusted advisor. These can be friends, these can be people in business that you admire, they can be professionals. They are, you know, and I disclosed to you at the beginning of this that I have a ministry background. The Bible talks about there being wisdom in the counsel of many. And this is, you know, that's kind of what this is geared toward, is to have you, I'm trying to have you build a team of people around you that you can go to when you have serious decisions to make. And even if that meeting costs you $500, an ounce of prevention is worth a pound of cure. And then finally, I said it during the presentation, if you think it's expensive hiring a professional, wait until you hire an amateur. So that is the end of the presentation. Does anybody have any questions? And while we're doing this, Carrie, I would really appreciate your feedback on these evaluation forms. Look, listen to me, I said valuation. You can tell where my head is. I would really appreciate your feedback on these forms. I will say this, if you are interested in, if you have more questions or something you don't understand, and you are interested in a follow-up like a webinar or even some kind of additional meeting, down at the very bottom, just write webinar. I would also ask you all if you are interested in receiving, we do a newsletter once a month where we try to produce good content. Like this will be part of what goes out in our newsletter. Carrie is our HR professional. So put your company name, name and email address if you would like to receive a copy of our newsletter. And what am I leaving out? Anything? Any questions? Yes, sir.
Early on in the presentation, you just quickly referenced QuickBooks, and I didn't know if you were doing it casually as a tool that can assist, or potentially, you know, you were maybe like taking a little dig, like, you know, always go QuickBooks. Just your position on QuickBooks as being an aid.
Yeah, so the question was about a reference that I made to QuickBooks earlier in the presentation. And yeah, it certainly wasn't a dig because most small businesses are using QuickBooks. We have several clients that use QuickBooks Desktop, QuickBooks Online, QuickBooks Contractor. I don't have an issue with QuickBooks at all. I've been using it for 25 years, so it's one that I know the best. That's probably why I mentioned it. We've got clients that use Sage or, you know, the old Peachtree. We've got clients that are in different custom industry specific solutions. We've got clients that are, you know, on different web platforms. So I mean, there are all kinds of systems. So whatever that is, what I was referring to was just your accounting system, assuming you have one. And if any of you don't have one, hopefully after this, you want to have one because you should.
And I was primarily inquiring because I love the reference to how it's good to have a team of people with maybe different backgrounds. I am the chair of my church's trustee ministry, and so I have a longstanding businessman, an accountant, a personality. I've worked in banking, and we're all kind of bringing our level of expertise, you know, to work in this committee or ministry. But recently we brought on the QuickBooks system to kind of assist and or aid with better managing and balancing of those monies. And I'm still trying to get accustomed and used to it. I'm not really hands-on with it like my other team members are, but I just kind of wanted to get your feedback.
Sure. Yeah, it's just as you know, it's probably one of the most popular solutions, but I no issue with QuickBooks at all. And I'm on several boards as well at the the finance committee. Imagine that, I'm on the finance committee at my church. But if you have any questions, give me a call. I do have some cards up here. If anybody, you're welcome to call me if you have any questions or need some help. So here, I'll give you one of those. There you go. All right. Yes, sir.
On your footer here, the accounting, HR, technology, operations, and management. So today was focused on accounting, but does next level integrate those other 4 components in with the accounting, kind of gives you more of an overview?
Yeah, so good question. The question was about at the bottom of our letterhead, it has some different areas of business. So, and a lot of that has to do with the way our business has evolved over the years. We used to be a full-service IT provider, one of those first partners. But really so we are an accounting partner. The business or the management part of it is really all kind of wrapped into, just the executive experience or approach from an HR perspective. And from a technology perspective, our service that we provide is really about software selection and implementation. So when we go into a company that is completely paper-based, helping them find the right solution for for that business, and then helping them implement that. One of the biggest misconceptions about purchasing and implementing software is that when I buy the software and I pay the implementation fee, it's implemented. And that's not true. I mean, the majority of the time, there has to be a much larger effort inside the company to integrate that system into the culture, and also not to just look at their existing business processes and say, how do you do what you do? Let's do it that way in the system. How do you do what you do, and why do you do it that way? And what does the system do, and what are its capabilities? And how can we modify your processes to make you, so there's this larger intentional effort that goes into that. And so that's what we are unique in that we pair the HR and the accounting and the technology. So we're really kind of like that back office support for small businesses. So does that answer your question?
Yes, sir.
Okay.